This video is how to trade crypto on Bybit. We're going to look at the futures trading system on Bybit, how to navigate this entire system, and also input and exit orders on here. There are about 20 or more sections of this video. I'll put everything down in the description below as timestamps. I do have a beginner's guide video for Bybit. I'll leave that in the description. It goes through getting set up on the platform and more of the beginner focused stuff. But for right now, we're going to get set up with the futures platform. So come over to Bybit, link in the description to a deposit bonus as well for Bybit. If you are signing up, you can use that link, and when you make a deposit, you can get a big futures bonus. Check the details via that link. I'll leave it below and as a pinned comment as well. But once we have the Bybit platform open, we can just click here to sign up for an account. All you need is an email address if you want to trade crypto and deposit and withdraw crypto. If you want to deal with fiat currency on the platform or get some of the other features like Bybit card, you will need KYC there, but just for trading crypto as of right now, you don't. Now, if you use that link, you can get that deposit bonus, and then you can come up to your reward center right here, as you can see, and you can check your rewards and any other campaigns that are going on right now. Just check the details via that link. We can also check the trading fees on Bybit if you are looking to actually get set up on Bybit before you start trading, as you can see here. Now, if you're trading in the spot market, you're being charged 0.1%. As we can see here for futures and leverage trading and perpetual trading, we're getting a different rate for maker and taker. Now, if you are a maker of liquidity, what that means is you're using limit orders essentially. So we'll go through this throughout the video, but here is the order book. Now, most crypto exchanges incentivize you to actually add liquidity and add depth to the book. So when you're using a limit order and actually placing orders, if you're a buyer below the price and if you're a seller above the price, you're adding liquidity onto the book. And so crypto exchanges will incentivize you to do that by giving you a much lower rate. So as you can see, if you are a maker of liquidity, you only pay 0.01% in a trading fee if your order goes through. And if you are a taker of liquidity, that simply means using market orders, not choosing the price and just lifting everyone else's liquidity off the book. You are a taker of liquidity. You pay a slightly higher fee, as you can see, 0.06. Let's go through the derivatives trading screen then. You can get to this via any page in the Bybit platform if you just come up to the top and click derivatives. You've got a lot of different options right here, as you can see. So let's go through them. There's a derivatives portal, and that just takes you through to the main derivatives page. If you want to trade, you can click on USDT perpetual, or you can click on inverse contracts, as you can see here. So we're going to look at USDT perpetual for right now. So what we're going to do is come and click on one of the assets that we want to trade. Now you can also see copy trading. I have some videos on copy trading and for Bybit copy trading as well. So again, I'll leave them as useful videos in the description. We have options. Again, I've got an options video, so you can see that in the description. And then USDC perpetual. So you can use USDC, which is USD coin. It's a stable coin, very trusted, very large, or USDT, just two different options right here. And then as you can see, inverse contracts, which is slightly different, which I'll get onto later. So just click one of these. We're going to click BTC USDT, and then that takes us through to this main page. When trading crypto in the futures market, there are a few things that are different to just trading in the spot market, which is where you use cash to buy and hold. We're actually just taking positions on the price of an asset. And so it's a little bit different in the way that we trade it. So the first thing we can look at actually is how we fund these trades. So with derivatives and futures, which we're trading here and trading on leverage, what we're doing is taking a position on the price, and then we are funding that position with some collateral that we have. And there's two ways that you can fund your position. The first one is by using a stable coin like US dollar tether or USDC. So we can click on this one. These are the US dollar tether funded perpetuals. And so what we can do here is take positions on the price of Bitcoin, and we use US dollar tether to fund our positions. Now that's great for a lot of people, especially if they're wanting to go long Bitcoin. They can fund it with dollars and then obviously fund that leveraged. If they want to use leverage, they don't have to use leverage, but if they do, they can use dollars to fund that trade. Now what some other people do, especially those with larger portfolios, or if they have BTC, they may want to use inverse. Inverse is where you actually use the crypto coin as collateral to fund your trades. Why would you want to do this? Well, let's say you're actually negative on the price of Bitcoin and you have Bitcoin in your portfolio. You don't really want to sell it, but what you can do is take a short-term trade on the price, put some Bitcoin in here. Maybe you've got one BTC and you think the price is going to go down. You can actually use the BTC to fund your position, take a short position, and actually kind of hedge some of your exposure in Bitcoin at that price. So there's different ways for different people. Depends on how you want to trade. Mostly, you can use inverse if you have the coins already and you just want to speculate around the portfolio, or if you just have US dollar tether. This is actually a much more reliable collateral because obviously it's not moving in price along with your positions. So that's the really two options that people have here. We're going to look at US dollar tether perpetual in this example. Now, an overview of the futures trading screen. There are some specifics here as well. So we can obviously choose the assets that we're trading. And as you can see here, we have the price of the asset, which is Bitcoin in this case. And there's something that you don't see in the spot market, which is funding rate, as you can see here. I'm going to cover this later on in the video, but if you are trading, it's good to know what this is and how it actually affects all of your trades. The other very different thing with trading futures generally, and on Bybit as well, is that you can use margin. You don't have to use margin, but it is something that is possible to use, and you can click on these details here, and I'll get onto that in a second as well. The other thing as well is that you can actually use a take profit and a stop loss when entering your trades. So if we come over to the order entry screen, what we have here is a long position and a short position. In the derivatives market, you're not actually buying and holding any crypto, but you can actually sell or take a short position without holding any crypto yourself. So with futures, we're just actually taking positions on the price. We're not owning any of the underlying assets. And so we can actually go long, and that is essentially taking a position where we buy first and then sell later, hopefully above, or we can take a short position, which is when the system actually sells first and we aim to buy back later at a lower price. It's exactly the same thing, just in reverse. And so you can obviously take positions on, a bullish move upwards or a bearish move downwards, and you can decide that. You can also enter positions, as you can see here, at the same time as you make your entry, so you know your risk and reward before you actually make any trades. And of course, we have the order book here. If you're looking for a more beginner's guide on that, check out the beginner's guide in the description, which shows you what all of these things are, including the order book and how they work. Now we need to get some crypto into our futures trading account to fund our trades. You can actually just come straight to the derivatives platform here and then just click transfer, as you can see. Now, if you have some assets in your spot account, which is where most of them will be, you can just transfer them from that into the derivatives account and any amount that you would want. I'm going to go for BTC here as well and just, confirm that to click it over. That's an internal transfer, and so it's completely free and instant. If you want to know how to get some fiat currencies on and actually get crypto onto the platform first, come up to buy crypto, and then you can make a fiat deposit here. You can also deposit cryptocurrency from another exchange. Again, I'll leave that for the beginner's guide video. When opening a position on Bybit, you have 3 different options on how you calculate the order size. Before we get into entering any orders, if you come up here and say order by, you can actually click on these different options. So as you can see, we have order by quantity, which is the amount of the crypto that you're trading. I've got BTC here, but that will change if you're using another crypto. And so you can think of this as, let's say, 1 BTC would be 1 full amount of BTC, which is what the price is quoted in. We, of course, don't have to actually trade one entire coin at once, though. We can trade any amount of it. So we can maybe trade 0.5 of a Bitcoin, and you can see the value comes up here. So we can choose any amount of the quantity if you want to do that. For some people, it may be easier to actually look at the order by cost. As you can see, we can change it right here and then press confirm. And now we are actually looking at how much it is going to cost us. So if we put in 500 right here, you can see we would spend that amount, right? So how much is this order going to cost us in terms of how much do we have on our account? How much will we spend on this order? The other thing is order by value as well. So we're going to click on this. Now this changes dependent on how much leverage you're using. So let's put 500 in again. And as you can see, the cost is now different. Now this is because when you use leverage, you actually are getting given some leverage by the exchange to open an order of a specific size. As I said with derivatives, what we're doing is putting an amount of collateral on our account to fund positions, essentially fund losses. So any losses that occur, that money is there to fund those losses and to unwrap your positions if you're making a loss and get liquidated. Other than that, you can open pretty much any size order that you want, depending on how much leverage that you want to use, which I'll go over in a second. But as you can see, the order by value now, we are thinking about the total order value. So what is the actual value of this order that I am putting into the system? That will be the total value of the trade and the position size, but the cost is less than that because we are actually using leverage. So 5x leverage, obviously the cost would be around $100 for us, and 5x leverage, 100 times 5 is 500. That would be the order value in total. So you can work that out in any way that you want. You know, maybe cost is easier for you if you know you have a certain amount of assets on the platform. Let's say you have, $50, which is in there. You can say, I want to make sure that I spend 25 and the value is now 122. You can see that, and it shows you the quantity here. So it does work it out underneath, but that's a good way to choose any method that you want of actually calculating the cost of the order. How is leverage used then on a crypto trading platform like Bybit? Well, when you trade futures, you don't have to use leverage. You can use 1x or 0x leverage and just put in an amount like $1,000 and then have the position $1,000. And so that's it. There's another way where you can use leverage, which is where you put in an amount and then you actually leverage that up by 2, 4, 5, 6x. And so the position size is much larger and you're using the underlying cash to fund potential losses. Here's how it works. If we have an order cost of, let's say $1,000, as you can see here, with 5x leverage, you can see the value is obviously around about 5,000 with some trading fees and everything like that in there as well. Now we can come up to this box right here and we can choose between cross and isolated. Cross margin is where it takes all of the collateral across your derivatives trading account. So if you have some dollars in there, it will fund all of the different positions. You can choose the amount of leverage that the average order would take normally right here. So you can change this on an order by order basis, or you can just have it as whatever you want normally to use. You can put that here for longs and for shorts. And so you can do that, by those two different positions. Most people will use isolated simply because each individual position is isolated in the collateral that it uses. So if one of your positions blows up, the other ones, you'll have some collateral there still funding those. Most people use isolated because it's a little bit less risky, because if you're using cross, you may have 3 positions that are doing great, one that goes south and takes out all of your other positions. And so it's a little bit more risky in that sense. So isolated is what most people use, putting collateral in each position individually. So you can choose the amount of leverage from no leverage up to whatever. Now, most people will trade maybe 10x or below. Leverage is risky, and as an example, it does make your wins more and your losses much more. For example, if you had $10,000 on your account and you're using 10x leverage, you can open a position of $100,000. Now that $10,000 on your account, which is your cash, if that position moves by 10%, so that $100,000 position that you've just opened, if that goes south and you actually lose 10%, that's $10,000, your entire account is wiped out. And so by using 10x leverage, just a 10% move is going to wipe out your account. So that's why leverage is considered dangerous unless it is used appropriately with some stop losses in place. And if you're using too much leverage, a small move is going to wipe you out, which is why leverage is considered dangerous. So everyone can choose this and choose the amount of leverage that they want and that they feel comfortable with. The best way to work out if you're using too much leverage is to look at the order calculator on Bybit. So we can come up to the order screen, click the order calculator here. This will come up on screen. And now what we want to do is look at the liquidation price. So if you're using isolated margin and going long, let's say I'm using just 1x leverage, we can see here that if we have an entry price of 25,000 for Bitcoin, because we're using no leverage at all, the thing can basically fall almost 100% before we actually get liquidated, right? Because it's just eating into the cash that we have on our account. And so the liquidation price is miles away. Now, if we're using 10x leverage, you can see that the liquidation price moves much closer to our entry price in this instance, which is 25,000. Why is that? Because our leverage is so much larger, our position size is so much larger, and so a smaller percentage move on that larger position means that we're essentially eating into the amount of cash that we have on account to fund that position. And so the more leverage that you're using, if we put in 25 here, you can see a small tick down is going to wipe us out. And so that really is important when we're looking at stop losses when we're actually trading. So what we always need to make sure is whatever our stop loss is. So if we're getting into a position right here and we say that our stop loss is, a few $1,000 below, we need to be absolutely certain that our liquidation price is nowhere near our stop loss. It has to be underneath our stop loss, because we need to stop our losses on a losing trade quickly before it actually comes down and starts to liquidate us. So we can use the stop loss price and the liquidation price to understand, are we using too much leverage? And then we can dial that back a little bit, or you can just simply, have a, more collateral in there. Now you can add collateral positions as well to fund them further, and I'll get onto that in a second. I'll show you a limit order on the system and all of the different aspects of each individual trade right here. So we can open right here. So we're opening a trade. We're using a limit order. So we're choosing the price. Now I'm going to choose a crazy price that is, below the actual current price to show you how this order entry would work. So the limit price that we want to buy or go long, Bitcoin here is 19,000. Current price is way above. And the order cost is just a nominal amount, as you can see here. The value, because we're using some leverage, would be a little bit more. So we can actually use buy long or sell short with a take profit and stop loss. So if I click on this, you can see the other order entries come up. Now what the system will do is enter your limit order on the screen, but it will also enter two other orders as well. One is a take profit above the current price if you're going long, and then the stop loss below that price if you're going long as well, to stop any losses and make sure we don't get liquidated. So if you're entering an order at say 19,000, you could enter a position. So I want to make 25% profit or something. I would not recommend this. I would actually use, some technical analysis or something like that, which I'll get onto in a second. But let's say we want to take profit of 20,000, which would be $1,000 above, and we want to stop at 19,500, stopping losses. So what these are orders that will be placed in the system when this initial order comes through, if it actually does. So you can see that. And now we can actually use some other options, for example, post only. So post only is to do with these maker and taker fees. So when you're using a limit order, obviously we want to get those maker trading fees, which are a little bit cheaper. Now, if you're using a limit order that is extremely close to the current price and has a very high probability of getting done straight away because the price is moving around, you may actually use a limit order, but because the price has moved by the time that you've pressed the button, you may actually go through with a market order, because if you have a limit price that is above the current price, it goes through as a market order anyway. And so what you can do here is press post only, and what that means is if your limit order actually becomes too expensive above the current price, if you have post only clicked on, it will not go through and it will get cancelled, and that prevents you from paying those slightly more expensive fees. It's something that you might want to tick on. Now, as you can see here, good till cancelled. This just means that the order will be good until you physically cancel it. Immediate or cancel means that if the trade can't go through immediately, it gets cancelled as well. And fill or kill means if only partial amounts of the order can get filled. For example, you want to buy 1 Bitcoin at a certain price and it can only fill 0.25 Bitcoin, then it will kill the entire thing. So fill or kill means either the whole thing gets done or it cancels off. So you can choose those. Most people use GTC. So I've got this limit order in here with the take profit and stop loss at 19,000 price. So I'm just going to click open long right here. It does give you a preview of the order by default. So let's go through this. The order price is 19,000. That's our limit order that we want to go long at. We have the quantity and the order cost and value, the liquidation price, as you can see right here, and then our take profit and stop loss. I just had to edit the stop loss a little bit because it was obviously above the entry. Leverage, you can see 5x leverage as well. Time in force, good till cancelled. If you don't want this screen to come up as well before you actually enter orders, just click on this do not show, because you might want to get orders done straight away. So you can press confirm right here, and then that order comes in. So order submitted successfully. Now down here, you can see our active orders on the screen. So what we have is our limit buy order in Bitcoin. We can see the quantity and the order price. You can click on these pencil icons to obviously change this as you want. I'm just going to click yes on that because we don't want to change it. We can see that it's a long order, and we have our take profit and stop loss here as well that you can actually put in and edit as well if you want to. You can also see the limit order on screen as well. So this is actually on the chart. You can see this as well. So you can zoom in here. You can actually, if we zoom in, we can actually change this order. So if you click on this around, you can actually drag it down, and then it changes, as you can see, to 18,623. So you can actually drag the limit order to different amounts that you want to trade at. So you don't actually have to enter that down on this position here. So, you know, if you're looking at support and resistance levels, you can drag that around and change it on the chart just like that. If you want to cancel an order before it goes through, you can just click the X on this button here as well, or you can come down to the screen, the order screen, and then just click cancel. If you click cancel like that, that limit order will now obviously not be there, and all of the other orders as well will also be gone. So you now have no orders on the screen. Bybit also lets you use conditional orders. Now, conditional orders are slightly different to limit and market orders. A conditional order is when you give an instruction to the system only to enter another order given a specific price. So if the price of Bitcoin moves to a certain level, only then enter an order as I tell you, which could be a limit or a market order. It's up to you. So as you can see, what you get with a conditional order is a trigger price. So let's say we have the trigger price at 26,000. We would usually use conditional orders potentially as breakout orders. So you actually use these as a breakout trade. You would not obviously use below the price because you would just use a limit order in that case. So let's say we have a trigger price of 26,000. What we're saying to the system is when the price gets to 26,000, open a limit or market order for me. If you want to use market order, then you don't choose the price. If you want to use limit order, you can actually choose the price. So you may say at 26,000, open a long for me with a limit price of 26,000. You may say 25,000 or 25,800. It's up to you, but that limit order would go in. Now, if the limit order is above the price, obviously it would just go through straight away as well, and choose the order quantity here. Why would you use a conditional order? It's really used for breakout trades. So as an example here, we're actually at a quite important resistance for Bitcoin. As you can see here, we have this price that is trying to break out from this previous resistance level. And so you may be unsure of what's happening to the price, whether we get rejected down to this level, or if we break through it, you know, it may go to the next level. So what you can do here is actually say, I'm going to wait for a breakout, and I'm going to only put in an order when we reach around 25,500, something like that, right? So if the price actually reaches this level here, which would be, let's say 26,000, then we actually put in a breakout order and go long and try and trade that breakout. Now that's something you could do physically, but sometimes you're not at your screen, and so you can put that conditional order in to actually trade here. Because if you put a limit order in, it's going to trade you straight away, of course, because the price is under 26,000. So that conditional is essentially used for breakout trades a lot with conditional orders, mainly because we have limit orders and other types of order that we can use with futures for other types of trades. So conditional is really for breakout trading in this case. Once you have a position open, you can also add a trailing stop loss to the order. So I've just opened a market order right here just to show you. We have a position, an open position, and as you can see all the details right here, and we have the entry price and the mark price. What's the difference? The entry price is your entry price that you traded at. The mark price, this is the actual price of the crypto derivatives contracts, and this is a blended price of all the top crypto exchanges. So because crypto contracts are obviously not the underlying asset, we have to make sure that the price stays in a normal bound that is, you know, reliable. And so the mark price actually is the price, a blended price of all the top exchanges that gives you a real price of what those crypto futures contracts are trading at. As you can see, it's usually extremely close to the actual price of the contracts as well. So if you come up here to the order book, you can see that this is the price on Bybit that it's trading at. And then we have here the mark price, which is derived by an index price of the leading exchanges. They are almost exactly the same, but as you can see, they're not exactly the same. The reason why the mark price is important is because that is the price at which most of the contracts are actually settled at. And so if you have limit orders in or you get liquidated, they'll be using the mark price for that. And it might be slightly different to the market price that you trade on Bybit. And so you may think, hey, I shouldn't have been liquidated, but the mark price might have been there. So just to keep that in mind. We also have the liquidation price here, and then the position margin. If we click on this, we can add margin to our position. So if you have some extra US dollar tether in your account, or if you're using inverse futures, you can put some extra crypto in your account, you can add more margin. Now what that means is, well, you can add collateral and reduce the margin that you have. And so if you're getting close to a liquidation, or you think, I just want to top this up a little bit, you can put more US dollar tether in here to actually decrease the leverage. As you can see, decrease or increase. So you can choose this exactly how you want with how much you want to put onto the position. So that increases or decreases the leverage, which is a really great feature. We have unrealized P&L. This is as you can see, it will be 0 because I've not traded out any of the position. What we can actually do is cut a little bit of the position and take some of the profits if we have them. So if you have done that and you take some profits, what you can do, as you can see here, is choose a limit or a market order, and you can actually close, like we can see here, close price. So if we have a position of $1,000, we can close out $500 of that or something, and you can close a 25% of the position, half of the position, 10% of the position. You've closed that order. So you've reduced your exposure a little bit, and you can close some of it, and that will be coming as realized P&L. So maybe you want to realize a loss or realize a gain or some of the position. That will be in your realized P&L right here. Your unrealized is what's going on and what's actually running on your position. Now you can see TPSL, I didn't add one, but I can actually add them here. So you don't have to add them in when you're opening. You can add them later if you want to get it done quick. Also here you can see trailing stop loss. So we can add this, a price retracement. So let's say we want a trailing stop loss of $250. We can press confirm right here. What does that mean? Well, trailing stop loss is an order that actually is now, as I've seen here, $250 below my entry. So what a trailing stop loss does is essentially follows the position up by a certain boundary. So $250 in this case. So let's say I got in here. What would happen is the sell order, the stop loss order, would be $250 below my entry the whole way, and it would move up with the price and up with the price all the time. Now, when the price starts moving down, the stop loss doesn't move down. It follows it upwards at a certain difference, but it never follows down. And so when the price moves down, it just moves sideways. If the price eventually moves down into the stop loss, you trade out. Now, this is known as a stop loss, but it is actually, depending on the price, also a take profit. It's really just called a stop order because you can actually be taking profits here. For example, if the price went up and you moved up and up and up with it, you're now in a profit. If the price moves down, you may sell out, but you may actually just be consolidating your profit there. And so it may not be a loss in that case. It's just called a trading stop. So when the price moves up, it will trail it by the certain amount and will stop if the price moves down, and then it will actually stop you out of your order, and you may be taking a profit there. So you can edit that as you want. Maybe you want 0 here, whatever, press confirm, and that trailing stop in. How about if you want to get out of a trade very quickly? You're going to want to use a market order here. Now, like I showed you with taking out positions or closing some of your order, you can also come up here to the right hand corner and click close. And this closes any specific orders that you have. So we're trading Bitcoin. You can choose 20% or 25% to close. You can close your long, as you can see here. Now, what you can do with Bybit as well is actually open a short position in addition to a long position. So you can have an open and a short position open at the same time. Why on earth would you want to do that? Well, maybe you have a long position and it's doing really well, but you think in an even shorter time horizon, you may want to just scalp trade. You can open a completely separate short position without affecting your existing long position. So you can do that. But what we want to do if we want to close out our position is essentially just get out. So we can choose a limit order here, or we can just choose a market order, as you can see above my head. So I'm going to choose a market order. I'm going to choose 100%. I'm going to press confirm, and that's going to go through, and then my order is completely closed. Something else to keep an eye on when you have open trades in crypto futures is the funding rate. This is the same for every platform. This is a mechanism where the exchange tries to keep the futures trading price, as you can see here, as close as possible to the underlying assets price. Because they're not the same, the futures price can get a little bit out of whack. And so the way that the exchange tries to keep this as close as possible is what's known as the funding rate. Now, the funding rate is a mechanism that essentially punishes people that are trading along with the market and moving the price out of whack with the underlying. So there's only two ways the funding can be. The funding can be positive or negative. Now, if everyone is buying and going long in the futures market because they're trying, think the price is going to go up, they're moving the price away from the underlying, and maybe they're moving the price up the order book and just making the crypto futures price a little bit higher than the underlying asset. And so in that case, if you're doing that as well and you're trading along with other traders, you will be paying that funding if you're going long. And so if the funding rate is positive, that means that if you're going long in the futures market along with the rest of the market, you have to pay this funding rate to short positions and to other people that are going short, right? So as you can see here, the funding rate is 0.01. So if we put 0.01, we can work this out. There's a countdown, as you can see here, every 8 hours. So there's 3 fundings in a day, so we can work that out as 0.03. And if we times that by 365, we're looking at a funding rate right now of around 10-11%. And so that's an annual figure. So if you kept this futures position open for 1 year, this funding rate right now is around 10%. The thing is, though, is that this funding rate can change whilst your position is open. So if the price moves up further, this funding rate can go to 15, 20, 25%. And if you're in if that long position, you still have to keep paying that to short positions. And so it's something to keep an eye on. Now, for Bitcoin and for the larger assets, you're never going to get it too out of whack. If you're trading an altcoin, you can be paying 25, 30% leverage, funding rate for your long position. So always keep that in mind. And it can be a small difference or a big difference. Now, if you're trading over a week or so, you're going to be paying a tiny amount of interest and it's not going to make any difference. The longer you have the position open, it may make a big difference. Now, if this funding rate is negative, that means that too many people are shorting the price, moving the price away, and that negative funding rate means that short positions are paying that funding. And if you're going long at that time, you are receiving that funding. So this is something you have to keep an eye on when you have open positions in futures. There are ways to also take advantage of this funding rate and actually take funding in for yourself whilst keeping kind of what's known as delta neutral positions, whereas you're long Bitcoin in the spot market, you're short in the futures market, and you're receiving that funding, earning around 10% on your BTC, whilst taking obviously some risk with that futures funding. That gets a bit complex. I've got some other videos on that. I'll leave them in the description if you want to find out more. Link to the Bybit deposit bonus down in the description as well. I'll pin it as a comment if you are getting set up. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.